it can't be printed away this time. And if they try to, which they will, print it away, monetary excess, what's the prime beneficiary of that? It's always been gold. We're at a phase now where I think silver has likely, when this spread breaks out, to go up to 100 at least, more likely closer to 200 within a couple quarters. Gold will be going up during that time, but silver will just go vertical. When you go into a new reality, you do it quickly. You say, oops, I've made a mistake. I shouldn't have been in that same range for 50 years.
Michael Oliver, founder of Momentum Structural Analysis, it is a true pleasure to host you on Palisades Gold Radio today.
Thank you, Stijn. Good to be here.
Excellent. I would love to get started talking gold with you for a second, Michael. Of course, we have seen an incredible run, up 50% thus far this year. However, that was followed by quite a sharp pullback. Where does it leave us today? Is this bull market still roaring?
It's a pullback that there have been others like this, but they, everybody thinks that's it. It's all over. Oh, got to get out, take my profits. There's no comparison. If you go back and examine on a ratio scale chart, logarithmic chart, in other words, an eightfold move occurred between 1976 low and the 1980 high. 3.5 years, eightfold gain in gold. Okay. The next bull market started in 2001 and lasted till 2011. Eightfold move. We started from a low at 1,050. You do the math, okay? To even match those highs, gold would have to be over $8,000 just to say, oh, I'm doing it again. So keep that in mind. But there's other bigger things going on in the world, market-wise, stability-wise, and so forth, that can drive gold, I think, a lot higher this time. And this time, I think it's going to become institutionalized. And it ain't going to come back down. You may have some sell-offs and so forth, but I think it's going to be one country, another country, another country. Suddenly gold is now money again, recognized. And I think that's where we're headed.
Institutionalized, kind of like Doc Casey's, this is the last bull market take, where we would go back to a type of gold standard?
Yep, that's right. What would cause that is not just a thought process, but pain. Because that's what drives people to reject old prevailing ideas and go to some new idea. In this case, a resurrected idea that's already been there before for 3,000 years. Gold's been money, in a lot of places, including here, until Roosevelt and then Nixon got rid of that. So, I think we're headed there. And I think one of the factors that will help spark that sense of 52 card pickup, panic, is when you break the stock market. And I think it is in a topping process and has been since late last year. The S&P made a new high by 10% so far this year, above the early year highs. But many indexes and sectors did not. But anyway, I think we're topping in the stock market. And when that breaks, that creates a movement of money out of a bursting asset into what is perceived to be, oh, that's a better place to be. T-bonds aren't the alternative this time. In 2000 to 2002, and from 2007 to 2009, when the stock market went down, T-bonds went up in price, down in yield. So did gold. So they were both alternatives. This time around, T-bonds are sick. They're anemic. They can't get off the mat. And this leaves gold and monetary metals as the only real alternative. This chart you've got here was in our weekend report and some prior reports. It shows a spread relationship, what we call relative performance relationship, between each monthly close in gold divided into the S&P 500, express that as a percent, and you plot it on this percent chart. This goes back to 2013, when gold was coming down, of course, from 2011 to 13. Well, so was its relative performance to the stock market. So therefore, you see a decline in the spread value. But then over the last 11 years, we plot a red line across each of the relative performance rally highs in gold measured against the S&P. And good grief, we have a 4-point line, almost flat. This is what you call a massive base. We hit it in April, backed off, didn't collapse this time. Unlike the prior hits up there at the red line, you went down, down, down. This time we went down for a couple of months. No, last month we closed right back below that line. You close out over that line, meaning if you get any month where you can divide the price of the near front month futures contract, presently that's the December gold, divide it into the S&P 500 cash, express it as a percent. If you get to 60%, that's a breakout. We closed last month about 58.5%, right up against that line. Now this is, everybody says, well, we haven't broken out yet against the stock market. But remember, the S&P is a heavily distorted index. In fact, 5 of the front end stocks in that index are, they're all tech. Okay, NVIDIA, Microsoft, Apple, and et cetera, et cetera. And they constitute 30% of the entire 500 stocks. Whereas 5 stocks have the weighting of 30% of what's an index involving 500 stocks. So it's heavily distorted. Okay, flip the page and you'll see something interesting. Here we measure gold the same way back to 2013, but against the Dow Industrials, Dow 30, the top chart. And the bottom chart is an index people seldom look at. That's the New York Composite Index, which is, huge quantity of stocks, okay, but not distorted by front-end weighted symbols. It's more evenly spread among all the symbols. And we've broken out. Because you've already broken out of the base, where you can say, okay, measured against broad stock market metrics, gold is now freshly emerged into an outperform candidate. And when you break out of some base that's 11 years wide, that's this clear, you're not just going up for a few months. The relative performance is going to smoke for a couple of years, could be. It won't just involve gold doing better than the S&P. We argue it's going to involve both gold going up and the stock market's going down, further exploding that spread. Anyway, this is a situation people need to pay attention to when they think something is over. This is just beginning.
Incredibly interesting, because when you're plotting against these other stocks, you're taking away, as you mentioned, that concentration that you see. That also seems to be typical bubble behavior. If you look at the 2000s, the stock market, the S&P 500 back then was incredibly concentrated as well. This kind of highlights that the market is incredibly concentrated today. Yes,
absolutely. Yeah. The spread relationship is sort of stunning. You look at the S&P, which has a beautiful structure. I mean, it'll explode when you get out of there, the gold relative to the S&P. But it's already broken out versus broad indices. And everybody knows right now that, yeah, the S&P and NASDAQ 100 are highly focused on just a few symbols. In fact, there's 5 or 6 symbols in the front end of NASDAQ 100. Remember, there's 100 symbols in it in the index. 5 or 6 symbols up front are 50% of the index. Why even call it an index? Just call it a call option on 5 stocks. But anyway, but everybody knows it's distorted, and they're scratching their head, and yet it doesn't seem to go down, so they've given up on that notion that you have a distorted situation, which is fine. Because when it breaks, then they'll be surprised. That's...
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades, Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisade shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Definitely. You mentioned some historical parallels before, and of course, before this recording, we were also talking about what you've seen in the past, that gold might be breaking out against these multiple factors. You also pulled up MasterCard and Visa. However, when we're talking about these historical parallels, back then government debts were significantly lower. Could this time be different in the sense that it might be even worse than, for example, in the 1970s?
The bear market, you're talking the bear market in stocks now, okay?
Or a bull market in gold, both?
Yeah, no, it's going to be, I think gold will do more than the eightfold move, meaning $8,000. When we get there, I'll simply acknowledge in our reports, we told you it probably will match at least what it did twice before under global conditions that are hardly as catastrophic pending as the ones we have now. Okay. Stock market, when it goes down, usually goes down for 2 to 3 years. You go 29 to 32, 2000, 2002, 2007 to 9. And it'll go down between, S&P down 50%, for example, 2000, 2002. But during that same time, it wasn't excuse me, AI stocks, it was .com, internet. Okay. And all the claims about internet were true. It was going to change our life. Yet the NASDAQ 100 went down 82%. 82%. I mean, it might as well gone to zero, okay? It wiped everybody out, and it took till 2016 for the NASDAQ 100 to come back up to the nominal price high it saw in 2000. So not only did it break 82%, but if you didn't get out, and we did, by the way, say out in January 2000, it took 16 years just to get back to break even, and that's nominal, not counting the degradation in the money unit. So I don't know how far the stock market will go down, but I can say it will go down seriously enough and also create the more important issue for gold and for the global sense of uncertainty about what we've done before will be when the pain comes from in the wake of the stock market decline. That's when you see, if you go back and look at the data points that everybody likes to talk about, unemployment and everything else that the Fed looks at. The real bad numbers didn't come until after the stock market really started down. You might have had some marginal indication there's decay, but the real pain to the average guy in the street did not occur until, let's say, 2008 and 9, for example. Unemployment, et cetera, homes lost, et cetera. This time we have a much bigger crisis because we have a government debt crisis, not just mortgages, okay? We got Japan, US, there's others. It can't be printed away this time. And if they try to, which they will, print it away, monetary excess, what's the prime beneficiary of that? It's always been gold, monetary metals. And this time we happen to think silver is the one that will outpace gold starting very soon in a way that is likely to really shock people. I think we even have a chart of that in this report at page 10, I think it was. Yeah, there you go. If you can focus in on that a bit there, I don't know if you can or not. Yeah, the top chart, forget the bottom chart for the moment. Top chart is simply a spread chart. Again, divide the price of the front month silver into the front month gold, express it as a percent. And you can see this goes back to 2020, 5 years, okay. And there was a low in early 2020 when the silver price was less than 1% the price of gold. And you exploded up out of that hole. That's when we had that sharp rally in gold and silver starting in March of 2020 through late summer, later that year anyway. 6 months of explosion in price. Well, during that time, silver really gained versus gold. It was the better place to be. But since that, in fact, that spread peaked in early 2021, since then, you can see that the spread, the black line, has zigzagged down. What does that mean? It means, yeah, silver was going up all during that time. We're way higher than we were in 2020. We were $30 then. We're now, either side of 50. But it was underperforming gold. So gold's done better over the last 5 years. But during that time, you can draw a couple lines on that top chart, the spread chart, technical lines. There's the black downtrend, which you bumped a month ago, and then last month downticked ever so slightly from that line, thereby acknowledging the line as being valid, okay? And then there's the red horizontal line above you, on that spread chart, top chart, just above 1.3%, meaning divide silver into gold. If it's 1.3%, you're bumping that line. Okay. Actually, 1.32%, and you break out over that base. That base goes back 3 years. So it's a wide base. Why is this spread important? If you go back into the 1979 surge in silver, but silver had already been going up for years, just like gold. So they're both in bull trends, but silver was underperforming gold, much like this chart here. But in the summer of 79, 5 months before you peaked, the spread broke out, saying, okay, yep, I've been underperforming gold the last couple of years, both going up, but silver just not going up as much. Silver said, I'm now going to perform gold. Silver went up 4.5 to 5-fold in 5 months. Went from like $15 to 50, okay, in 5 months. So the bull trend went vertical, okay. The same thing happened late in the bull trend in 2010 and 11. We know the monetary metals peaked in 2011 after having been going up for a decade. But I think it was September of 2010, again, you looked at the price charts, gold and silver just trekking up, fine, everything looked good. But silver broke out on a spread chart that looked fairly similar to this one. And it said in September 2010, okay, now I'm going to beat you, gold. And silver doubled in half in 6 months in net price. Okay, so that's why this spread is important, because it tells us that we're at a phase where silver, which is vastly undervalued to gold, historical measurements going back 50 years, could zoom in relative performance and in net price. It is our argument, based on a lot of technicals we won't get into right now, but partly on the triggering of this spread, which you can see we're all about ready to break that black downtrend line. And the red line above on the spread chart that's total breakout. We're at a phase now where I think silver has likely, when this spread breaks out, to go up to 100, at least more likely closer to 200 within a couple quarters. Gold will be going up during that time, but silver will just go vertical when this spread breaks out. Now, if you look at the chart below, this is what we do. We look at momentum and structure. The spread chart has 2 breakout levels, and the momentum chart also has 2, except that the momentum chart's already broken out over its downtrend. Okay, heads up. And then that peak that we made in September and downtick slightly in October on the black line on the bottom chart, we already hit that triple top structure. Downtick slightly, didn't get slammed, very downtick. You close above that red line on the momentum chart, that spread chart will follow very quickly. So we're watching momentum as a leader. It almost always leads in this situation. So we have a situation here where we think silver is about to go vertical, but that is a signal that both monetary metals are about to go vertical, with silver in the lead. So this is what we're focused on right now.
Perfect. And plenty of follow-up questions I have on precious metals, miners, etc. Quick sidestep to momentum. You already started hinting at it. Perhaps you can explain to us why it is such a good leading indicator at times.
Hard to explain, except that it is. In other words, usually when we see a top in a market or a bottom, I'm talking price now. By the time the price chart says, ooh, I'm broken, you might be 20% off the high of the market before it speaks anything. But you'll invariably, when you run long-term momentum and you're trying to define a bottom or a top, the momentum of the action of price will have already broken out over a structure as well. In this case, as an example, you can see that the spread, the momentum of the spread, the bottom chart, has already emerged above the downtrend, whereas the spread chart is bumping the downtrend. So if in fact we do turn up from here, which I think we are, you'll see that momentum did it first. This is also true when you simply measure price versus the momentum of price. And it's our modus operandi. What the academic basis for it is this. We don't like wet noodle momentum indicators, like the kind you get on your quote screen, RSI and MACD that look like wet noodles. Okay. they don't provide structure. They just sort of say, oh, I'm at a high level, okay, which often is distorted anyway. The notion of what's too high or too low can change. But when you create momentum of price, what you've done is you've backed out of simple measurement of an asset measured versus a money unit. The price chart is nothing but silver ounce versus the US dollar, for example. Well, heck, the US dollar is degrading constantly. I don't mean versus other currencies. I'm talking about in and of its real buying power, because the quantity of dollars goes up like 90% every decade. Okay, so like when your granddad built a house, it cost $4,500. When your father built the house, it was $45,000. Right now, the median home price is $450,000. That expresses the ongoing decay in the real value of the thing in your wallet. Okay. To factor that out, that means you've got a yardstick that's plastic. So when you measure something year to year over a 10-year period, there's been a distortion in your yardstick that is messing up your view of the technical action. When you run a momentum of it, you haven't fully moved the money unit out of the equation, but you've at least injected the dynamics of the asset itself, its momentum, strong or weak, whatever it may be, into part of the overall measurement. So to some extent, you've stepped away from simply using a money unit as your yardstick. Okay, and that sort of cleans it up a bit, if you know what I mean. And it often gives you a structural picture that is different than when you see on the price chart. Pardon for the length of that. Okay.
No worries, that's exactly what I wanted to hear, and it makes perfect sense. It sounds like there's a great potential for a significant capital rotation out of the US markets or global markets into gold. Is that the case?
Yeah, no, I think you're going to see a major asset class movement favoring the monetary metals, especially silver. Now, I think the silver catch up to gold could occur in a matter of a couple quarters. That doesn't mean it's over at that point, by the way. Because again, I think during that period of time, if silver is accelerating versus gold, and also if that first chart we looked at when gold is breaking out versus the S&P, many events are going to occur in headline form that have nothing to do directly with gold or S&P, but have to do with macroeconomic trend, breakdown in certain institutions, panic among the public. I mean, think about it. If you're just an average Joe out there, you know, you've only got one thing in your financial horizon, your personal financial horizon, that you can smile about. That is, if you have a portfolio of stocks in your retirement account that is front-end loaded with AI stocks, okay, you can smile. You can say, oh, I'm up 10% on the year, or 15%. Most market indexes aren't, but okay. That's the only thing you're smiling about. Meanwhile, gold's up over 50%, silver's up over 60, 70% on the year. But if you take that away from the average guy, who doesn't even have that to smile about, he's already being pinched by cost of living. And what if his wife loses her job, because maybe they both work to survive, and maybe they're late on their mortgage payment, and we all know that credit card delinquencies are through the roof. Credit card use is up to max levels in many cases, more than ever. So all of these things can go wrong in the real world and change the nature of your view of reality. What's best? In fact, if you go to the very last page of this report, we have a very interesting chart. And this is just a little tap on the shoulder. The chart at the top is the Bloomberg Commodity Index. It's a price chart, monthly. It goes back to 2020, when it made its all-time low. You had that explosion, that more or less doubled the price of the Bloomberg, but even when it got up to 140, it was still, the high in 2008 was 238, okay? And right now, over the last couple of years, you can see Bloomberg's going sideways, Bloomberg Commodity Index, which is a well-balanced index with agricultural, base metals, energy, etc. It's been dead quiet either side of 100. Now it's broken out. The October close to us was a breakout saying, I'm awake again. Okay, but now the really important chart is not that commodities are about to go up again from very cheap levels. Again, 238 was the price level in 2008, and right now we're 107.8. You know, long way to go. We're not even halfway there, okay? Scroll to the very bottom chart. Yeah, that one. Blow it up if you can. Here we go back to 2000, and you'll see that the Bloomberg was gaining in value versus the S&P 500 from 2000 to 2008, okay? It went from like 7% value, divide Bloomberg price into S&P price. 7% of the S&P up to 18, that's more than a double in relative value. Commodities were the place to be. Okay. Even during the 2000 to 2002 bear market in stocks, Bloomberg was going up relative to stocks. Okay, and during a lot of the bear market, 2007 to 9, Bloomberg was still going up. Now finally it reached a level where it peaked in price. That's that 238 price level I mentioned. Its performance peaked at 18%. And then you blew through a floor, the red line floor, at about 11%. That was in 2012 and really collapsed. Bloomberg got down to 2% of the price of the S&P. I mean, it's like, who needs commodity assets anymore? We don't need the real world. We're living on paper. Okay, fine. It really ceased to go down in about 2020. And we had that rally in 2022 when Bloomberg doubled in price from 50 to 140, mid-50s to 140. The spread also upticked. But then it came down and sagged through those lows slightly in 2024 and has gone up and bumped that 2% level from underneath. If you ever get the Bloomberg back up above that 2% level, it's not a big event to do that. It's saying, okay, I'm coming up out of here. And if you ever get up above that 3+% level, the base is completed. And we're arguing that there is going to be a global perception and investor preference shift over a prolonged period of time now. We're not talking a 6-month rally here. In favor of real world assets and stocks that are related to those real world assets out of what we call the stock market now, which is largely, front-end loaded AI and so forth. So if this turns up, and I suspect on the coattails of gold it's likely to, especially since October close on those top charts was a breakout for us. I think the spread's probably going to turn up too. You get a little weakness in the S&P and a little upticks further in the Bloomberg, that spread's going to start to move. And when it does, you have an open void above you, thin air, before you can even find next resistance. And what that means is it's probably a good idea from an investment long-term, 10-year point of view. Where should I put my money over the next decade? Well, already Bloomberg, if you uptick over that 2% level, is telling you, I've not really been a bad place to be for the last 4 or 5 years. I was at 2% 4 years ago. If I'm still at 2%, for example, hey, I've really matched the value of the S&P. I've gone flat, okay? But you resurrect the spread, and it's saying it's time to look at the whole other part of the world. That's which is under your feet. And, what does that mean? It may mean, you break the stock market and it creates emotion. People say, what the heck should I be in? At least you can pick it up and touch it, okay? And we're arguing, don't be surprised if over the next decade, this is a good place to basically be from an investment point of view.
Incredibly insightful. I think this is what a lot of investors and viewers of the channel also feel, that the mining industry as a whole has been undercapitalized for a long time, and therefore might be a great place to park your investments. However, to play devil's advocate for a second, because of productivity gains in the economy, you would expect this ratio between the stock market and commodities to trend down over time. Isn't that correct?
Well, it has trended down. I mean, and I think it's about the base. It's saying, I've quit going down effectively in late 2020, early 2020, excuse me, and it really hasn't gone down that much since then. So it's really, if you'd bought the Bloomberg or bought a basket of commodities or commodity-related stocks back in 2020, you're not doing all that much less good than the S&P, okay? And if you resurrect yourself up into this base again, 2% plus, it's the first signal, the next one's over that 3, then the game's on. And I think this guy is saying to us, given what's happened since the last 5 years, I'm just not going a lot lower. What do you want me to do? Go to zero? Okay. So, I mean, this is one of these situations, you know, your father told you buy low, sell high, or your granddad did. Okay. This is a situation where it's a buy low situation, and we're not far away from rendering the signal that says it's time. And I think that could be related to two certain things that go on. One, a breakage in the stock market bubbles, especially the US bubble, which is the biggest in the world right now, in terms of duration and multiple gain since 2009 low, and a resurrection and an increase in inflation, because you know what the central banks will do when their stock markets start to create pain. They're going to have to print. Plus their own government debt markets you have to print to save them. You have no choice. And if they revert to that direction again, which they're already doing, it's an ongoing process with central banks. They always decay their money units. The question is, do they accelerate it? You break the stock market, that will accelerate that situation and will create money flow. And if it's not going into stocks, where will it go? Stocks related to commodities and commodities themselves. And we're seeing that. I mean, copper, for example, you know, crude oil is $61 or so right now. You get up to 68 anytime during this quarter, you don't want to close a month there, because if you do, it's going to take off. That's a major breakout for oil by our metrics. And various other commodities are rendering similar technical signals in sync with what the Bloomberg did in October. So it's time to wake up and think about a different horizon from a long-term perspective.
Well understood. And this commodity complex breakout, how should we envision that? Is that going to be a rising tide lifts all boats, or is it more going to be like a peloton race where you have winners and laggards?
That will be.
Moving forward?
Always will be. You're right. Because back in the 2000 to 2020 to 22 rally, which by the way peaked weeks after the war began in Ukraine, that didn't take it up. That's what peaked it really, and then you pull back. That was a pretty good mix of most commodities joining in on that. Energy tended to lead in percent gain basis, but grains gained a lot, copper gained a lot. It was a pretty broad basket. And even now, recently, platinum, which has been dead as a dog for a decade, has suddenly said, I'm awake again, in correlation with the movement in the Bloomberg, okay? Not with gold. Its correlation to gold is not good at all. But even platinum is back in the game. So, no, what we see, we examine all the major commodity categories each month and the Bloomberg in a monthly report. And we can see in almost every single subset of the Bloomberg similar technical signals that indicate this sector is going up. Grains, oil's going up. Natural gas, for example, has resurrected itself. Platinum has suddenly come out of the hole. Palladium, too. Base metals in general. So we see it as a basket situation, and I think it is not due to the specific fundamentals necessarily in each of those commodities, but in a broader movement of money into a broad asset category that is vastly undervalued relative to the paper assets.
Well understood. And earlier in this interview, you referenced a quantum leap for silver to $100 or even potentially $200. However, you also said that it might not be over after that, the bull market. Of course, previous spikes in silver have been relatively short-lived. Why would this one be different?
Well, again, this time around, well, first off, silver, let's talk about just silver itself. We've run studies showing the confinement that silver's been in for 50 years. $50 high in 1980, near 50 in 2011. Traded above 50 briefly, now trading around 48, 49. Okay. We think that not just price nipped out the high, and the problem there was you had an explosion just to get up and take it out. For example, you went up like 11 weeks in a row in silver, higher highs, higher lows, higher highs, higher lows. Doubled, like 50% increase in price almost, okay, 40%, matter of a few handful of weeks. So it needed to pull back, fine, okay. And you sucked in a bunch of longs who bought when it broke through 50. That's an idiot number. Yeah, it's significant, but when you real dollar value silver, go back to 1980 and try to convert $50 silver then to where it should be now, it'd be like $200 or something, okay? Something similar in the 2011 high. So they're ridiculous measure points to reference, okay? But when that spread breaks out, it's telling us we're going up, okay? Silver's going to beat gold. Now, what about the issue of, well, once they peak, won't they collapse again? Yeah, you'll probably reach a level where silver will drop very sharply. But again, it's going to be in a new reality. It's not coming back to $30 or $40 or 50. If you go to 200, yeah, you might have a $50 sell-off or something, but you're going into a new price reality. We ran charts, for example, going back into the late 70s, early 80s on copper and on lead. Exciting metal, okay. They lived in a range, the 70s, 80s, 90s, and into like 2005 and 6. So multi-decade range, where they lived in a rectangular range, price range, just like silver's been in for 50 years. But when they came up out of that range, and for copper it was like mid-2005 into 2006, in a matter of a couple quarters, copper price quadrupled. Quadrupled. Yeah, it had a sharp sell-off after that, but then it leveled off into a range of action since 2007, that if you cut through the middle of the range, it's about 4 times the middle of the range that prevailed from the 70s, 80s, 90s into 2000. So it quadrupled and then went into a new reality. Same with lead. Different time. It occurred in 2007. It like quadrupled in a couple quarters into a new reality, had a sell-off, but then leveled off into a reality that was like quadruple the average price of that multi-decade range, 70s, 80s, 90s, 2000. Okay. Silver hasn't done that. Why? Well, there's various valid notions out there why it might be. One has been manipulated and attempted to be contained by banks, possibly working in conjunction with central banks, et cetera, et cetera. And we know to some extent that is true because there have been actually convictions in that regard. But when silver gets out of the old reality, they don't do it incrementally. And this is not just true with copper and lead, by the way. We could have shown many other charts of different assets, commodity assets. When you go into a new reality, you do it quickly. You say, oops, I've made a mistake. I shouldn't have been in that same range for 50 years. I'm out of here. And when it comes out of there, all notions of norms, like overbought, RSI will be off the page. Probably stay there for 6 months. You better be long during overbought RSI. You get my point? And it'll go to a new reality. Now, we think also that once we get into that new reality, it's not merely a norm. Things are going to change in the world in financial assets, stock market breakage, sense of doubt about the validity of a government monopoly over the money unit. That's like, it's a socialist concept that the government should control an essential commodity and price it arbitrarily. Well, money is an essential commodity asset. It's the interchange between you and me if we buy and sell something. If I buy something from somebody who manufactured it in China or Europe, I don't meet them personally, but I exchange a money unit with them. And those money units are constantly decaying because the governments manipulate them for their own essential survival purposes to support government. But it's a distortion. They have a monopoly over the quantity of money and the pricing of money, interest rates. Does that make sense? If all of a sudden that concept gets into doubt, and there are already people talking about, hey, this Fed system, it's only been around 100 years, hasn't really worked. We've had boom-bust monetary policies with boom-bust stock markets. Is it really working? Or has it been in process of ongoing decay in people's money units? Those kind of questions could arise, or are likely to arise in this next phase of what's going on here. And it's being expressed already, I think, by gold and silver.
Yeah, and the questions only seem to be accelerating, of course, since the dawn of quantitative easing. This process only been accelerating as well.
Yeah. No, it will speed up. Just like we argue that silver is likely to go to a new reality and do so quickly. And that's my main focus right now. It's not the next 10 years, but the next 6 months, especially when you break that spread out. When that occurs, other things will be occurring too. It won't just be gold and silver going up. It's likely to be the stock market going down. It's likely to be the real world in the street consequences of that event. Unemployment exploding, doubt about the validity of certain notions of government doing this or that. And when you get to uncertainty, that brings in emotion. And emotion often brings into doubt certain institutions where people say, just clean the deck, let's start over, let's do something different. And I think we'll be at a tabula rasa situation at that point. And silver and gold will be the place, the perceived place to be. Golly, I wish I'd done that. You know what I mean? And base commodities as well.
You think a reset could happen that quickly?
I think the noise effect, the panic effect could occur that quickly. So if silver does and gold accelerates from here, and even if gold just went to its normal full move, go to 8,000, people would be pulling their hair out. And yet it's done it before. What are you crazy about? Yeah, when you look at an arithmetic price chart and you run RSI or something, you think, oh my gosh, it's got to be. It hasn't even begun, especially if one, you break the silver gold spread out. Okay, that indicates silver is going vertical versus gold, and that always means silver is going up more than gold, not the other way around, going down less than gold. I'd also, if you break gold out above that very narrow S&P 5, we'll call it, then it's signaling a major asset class move just beginning. So it's not the end of something, it's the beginning of something. And people, I think, need to put this into the context when they're looking at the simple price chart of gold and thinking, my gosh, yeah, you're going to have downturns. Get used to them. The issue is, where was your point of entry? If you entered at proper places, you don't care. Yeah, you're going to suffer 10% hits here and there, but it's going to go away because you're not through. If you see the broader context, and everybody thinks every 10% drop is the end of it. No, it's not. This happened in the middle of, for example, the 79 to 80 move, or the 2010 to 11 phase in silver. There was a month in the middle of that 6-month process where you had a bad month. And you said, oh my gosh, that's a reversal, it's all over. It wasn't. Turned around, went right through it again. Okay, so if you're a late comer, yeah, you might get shin kicked. But again, if you were an investor at the appropriate places that MSA defined over the last 10 years, and said to don't get out, then take it. It's just part of the process.
Take it on the chin. And if you're a generalist investor who doesn't have any allocation to precious metals as we speak, is this pullback that we've seen in gold and silver an attractive entry point?
Yes. We think that the break we saw a week ago, most of which occurred in one day, but and then we rebounded from under 46 to back up to high 48s, I think today even. I think that was probably it. And the issue now is coming up out of here, and I think we're on the edge of that. There's some numbers we put out in our reports that will indicate, a little tap on the shoulder that, okay, this rebound from that low is in fact going back up and take out the old highs, 53 plus. And after a breather, and then expect it. This is market reality. Again, it's the point of entry is your real problem, not that the fact that you have these zigzags occasionally. Yeah, and if I were looking at the monetary metals, my emphasis would be silver, especially when that spread breaks out, silver, gold. And my emphasis would be the miners versus gold. Gold or silver miners beating gold. That will happen as well, but especially the silver miners. So my personal positions, which I put in a disclaimer in the report, show that I'm in primarily silver-related positions.
Talking about the miners for a second, both gold and silver miners, is it mostly a play of picking the right individuals that provide that incredible leverage?
That is always handy if you can do it, and that's a debatable issue because a lot of the so-called fundamentals of a company will be dwarfed by the simple fact that they're sitting on bullion. How much is sitting on the ground below them that might be, for example, some small silver miner might have a lot of silver underneath it, but it may be too costly right now to mine it efficiently in there. But you take the price up, suddenly that silver becomes totally producible. And it's more of an issue of how much bullion effectively do they have under the ground. You might find that it's 10 cents on the dollar. You know what I mean? So you're not buying the company that runs the mine, you're in effect buying their assets, which is, again, unrefined silver under the ground. Think of it that way. And I think that what will happen is, yeah, there might be select here and there outperformers. That's always the case. We do studies on that constantly of what's the outperformers within the gold silver mining sector, which symbols are doing better than GDX, for example. And that constantly changes. That's true with any sector. You pick tech sector or energy, there's stocks that are doing better than other stocks within the sectors. That's a constant. But that shifts and changes. I'm looking at it more as a basket right now. In fact, I think you could throw darts at junior miners, and maybe 2 out of the 10 you hit are duds, and the other 8 will go off the page. Some of them will get bought up by bigger miners, as a cheap asset. Anyway, I think that's what we're sitting on. And I think even in the wake of that, the gold, silver leading, I think this commodity asset category here is about to do something from I'm not going to argue suddenly and as dramatic as gold and silver, but an uptrend that's worth participating in from an investment perspective, not just a trading perspective.
Sounds very exciting, and it sounds like if you want to get the maximum exposure to this precious metals bull market that you're outlining here, this breakout, you would almost want the marginal producer, or you almost want the developer that, like you outlined, might not be economical as we speak currently, because they will provide the most leverage.
Yeah, but again, I'm treating the miners, and I own a bunch of the big name silver miners. But I'm also looking at some of the juniors, and we don't examine what a lot of mining experts do, which is what do they have under the ground, what's their cost, all these factors. And there's another popular assumption out there: if energy goes up, that's going to cut into their profit. Their profit margins have been discounted so severely in terms of what they're really making that suddenly there's a wake up. And yes, energy is a key factor. So if oil turns up with the Bloomberg, people think, oh my gosh, that's going to hurt the gold miners. Yes, it will be a factor in their overall profitability, but it'll be trivial compared to the bullion price increase that they're going to enjoy. So all of their projections, miner by miner, of what's our profit going to be this year based on what? The price of silver or gold, all those assumptions go out the window. Throw the paper away. Because if these markets do what we're arguing, all those projections are next to meaningless. And if you go back in history and look at big ups in oil and big downs in oil and put a gold mining ETF underneath it, you'll see it didn't halt GDX advances or declines. In fact, they weren't out of sync at all. Oil can go up and the gold miners go up at the same time. So it's a false notion.
Talking about oil and gas, you outlined earlier that if oil goes to $68, it might break out. When you're looking at producers, fundamentally speaking, some of them look incredibly cheap, providing 10% dividend yields. Are you seeing something similar technically? We examine the producers as well. For example, we assess the ETFs like XLE, the broad energy ETF, XOP, OIH, they're all energy related, and some of them are much cheaper than others. But if oil breaks out in sync or lag to the Bloomberg, and 68 is our breakout number, and if you look at a price chart, that doesn't mean much. Heck, we were in the upper 70s a couple of months ago during that Iran strike. The idiots bought it on war news. Never buy war news, okay? And it fell back down under 60, and now it's firming again quietly. It will find its own reasons to go up, and we're not concerned about that. We're looking at it as one, it's a cheap asset. And the miners, though, if you look at XLE, for example, it has not fallen down as much as oil has. You go back to the 2022 high in oil, which is 130, it got cut more than in half. Whereas XLE ETF of the broad energy sector, it dropped some, but basically it's been range bound. So it's holding up quite well.
And by the way, the trends of those oil sector ETFs is not in sync with the S&P. So if you're worried about, quote, a stock market downturn, it will not correlate or negate an oil sector upturn. In fact, they're often opposites. So don't be too concerned about that issue.
Really interesting to hear you say that, because oftentimes we hear that oil is incredibly recessionary, and because it's so inelastic in demand.
Yeah, well, again, look at its price. Historically, we're at 60, and as I understand, and I don't try to pay attention to these data points, most producers are not really wanting to hedge the oil, because they said this is ridiculous. This level, I don't need to hedge it. So that's just not going to sustain on the downside. I think they're right. Our assessment is oil is just cheap relative to its own prior highs, 140, 130, and even at 60, you're lower than most of the price action of the last several years. So one, it's cheap. So forget the issue of, well, we have an economic downturn. Does it mean we're not going to consume oil? No. In fact, AI has generated a problem in energy production. We know that. They need more. Even natural gas and coal, for example, being sought. So it's an issue of the relative cheapness of it. Now, if oil were $200 right now, I'd say, yeah, maybe you could, because relative to its own price history, that's pretty high. But at 60, no, that issue is not an issue. So again, I wouldn't try to correlate economic trends with the price of oil. They don't correlate well, nor do the trends in the stock market correlate well to oil.
Yeah, there have also been plenty of recessionary periods in which the oil price spiked significantly, hasn't there?
Mm-hmm. Well, during the great global stagflation, which for commodities began in 77, gold made its pullback low, hit 275, and then by mid-76, it was down to 103. Been cut in half. Measuring from that bare low to 1980 high, it took off from the 76 low, mid-76. Commodity category, then using the CRB index, didn't turn up till mid-77. So it was lagged to gold. But all during that time, stock market was a wasteland, and yet commodities exploded. And we're in a global recession, yet commodities exploded. So keep that in mind.
Definitely. Very well understood bearish call on US stocks, very much bullish on commodities. What about international stock market? Should we expect contagion there?
We're a global world, and therefore what happens here affects Japan. What happens in Japan affects us, Europe as well. Okay, so now admittedly, Japan is a bubble, the Nikkei. It is a bubble, much like the US stock market, in terms of multiple gain since that last major bear low in 2009. The multiple gain over that protracted period of time, and we know why. Is it because the economy's really gotten better? Not really. It's because the Japanese print a lot of money. They're experts in that. They invented QEs. Bernanke picked up that game in November of 2008. He said, okay, we're going to QE. And the stock market kept going down for 6 more months, but it finally engaged, And since then, you've had monetary policy excesses for 15 years. Money growth's been quite good. Fed funds rate, 0 in 10 of those 15 years. I mean, what do you want? Free money, It's party time. And even when they upticked it to 5%, which is trivial when you go back and look at a Fed funds rate chart going back 75 years or so. The Federal Reserve of St. Louis site has this. Even 5% is like a hiccup at the lower quadrant of the last 75 years of prevailing rates. So in effect, we've been drugged with free money and a growing quantity of money for 15 years. Japanese engineered it, the QEs, we adapted it, and all kinds of variations thereof, and we're going to revert back to that full throttle. I think the Fed is already in that direction. And will be especially more so next year once these events start to unfold. They'll be provoked into full throttle, pedal to the floor. And again, but the problem is when you go back and look at 2000 to 2002 bear market, 2007 to 9, they went full throttle then. Didn't help. Market still went down hard because once the bubble breaks, reality takes over and says, heck with you, Fed. We'll take your money, we'll go put it somewhere else. And the prime beneficiary was gold.
Incredibly insightful. I would love to hear a bit more about, of course, what you do over at Momentum Structural Analysis.
Well, again, we explained the theory behind our work, which is to try to take a step away from simply using a plastic yardstick. What's this asset worth versus the yen? What's it worth versus the euro, dollar, et cetera? Those yardsticks are, like if you tried to build a house with a 36, with a yardstick, and then 6 months later it still said 36 months, but in fact it increased by 3 inches, then the second half of your house wouldn't quite fit with the first half and it'd fall down, okay? So be aware of that when you price things based on a money unit. Now, as far as the other stock markets, there are some that are not bubbles. Europe is not much of a bubble compared to us or Japan. It's going down too. I mean, we're connected to Europe economically. So we go down, they're going down, okay? Or they go down, we're going down. China is not a bubble. Their current price level is only double plus a little bit more than the double where it was in 2009 when it made a bear low. We're 11-fold in the S&P, 20-fold higher than that in the NASDAQ 100. So there's no comparison of our market versus, let's say, China now. So yeah, China would likely suffer economically if we suffer. They're part of the global, they sell stuff to us, okay? But their stock market's not a bubble. So on a relative basis, it's not going to go down like ours if it goes down.
Please tell us, where can we find out more about your work, Michael?
OliverMSA.com. We put out major weekend report, usually 10 to 15 pages, covering most asset categories. In fact, we cover all 4 of them. Foreign exchange, key foreign exchange markets, government debt markets, stock markets, and commodities, including especially gold and silver. And during the week, we probably put out about 4 reports a week on this or that special situation. So you get a lot of volume of stuff to read. So
incredible. Thank you so much, Michael. Really appreciate it.
Thank you.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.